Who drives currency pairs? Government intervention and currency manipulation. Huh?
I'll let you, don't worry.
Okay. Hedgers. Participants who look for the.
What you doing?
I'm like reading something off a page. Government interventions and currency manipulation. Hedgers, participants who look to the forex market as a place where they can reduce exposure to risk. Speculators, opposite of hedgers, look to the FX market as a venue where they can take on risk in hopes of profit. Manipulators' sole purpose for jumping the market is to manipulate prices. This can be viewed as healthy for the market. Facilitators make money by enabling hedges, speculators, and manipulators to place their trades. Central banks are manipulators of trade imbalances to provide liquidity and reduce volatility and the value of the currency during times of financial crisis. To drive the value of the currency higher or lower can inject more money in the circulation to lower prices and take money out of the market to lower than as unsterilized currency intervention. The central bank takes no extra steps to combat consequences of intervention. Banks are facilitate currency transactions for long corporate clients and even individual travelers. A corporation exchanges 100 into euros. The bank has an addition 100 million, but is now short of euros. Side effect is the bank must now hedge this position. Okay, I like that. Government, banks are hedgers by necessity. They are driven to hedge the currency's risk that they assume by acting as a counterparty to clients who are looking to exchange currencies. Hedge funds are speculators. They are pools of money that are raised from wealthy individuals, pension funds, endowments, corporations, and others, and are managed by a fund manager. Retail forex dealers, the Feds, play a key role in the life of any retail trader by providing a conduit into the FX market. RFEDs can be facilitators or speculators. I need glasses on. Where's my glasses?
You don't know your glasses?
No. Okay, I need my glasses.
Why are they chewing on a straw?
I don't know.
It's your hobby?
I had a Capri Sun. Offset flow. A book. This portion of REFED's portfolio that is chooses to offset by placing corresponding traders into the interbank market. Managed flow portfolio B bank. This portion of the REFD's that portfolio that is chooses not to offset in the interbank market. Who awake the trading? Who awake and trading? Who's awake during the 24-hour trading cycle? Trading day first begins with New Zealand, Australia, Asian markets, and then Europe, and lastly the US. So the first market that opens is basically I'll explain how January first begins with New York and London overlap at 8 a.m., making this period the most liquidity from 8 to 11 a.m. The transition from New York close to Tokyo open is relatively quiet in the market from 5 to 6 p.m. Currency pairs involving the Japanese yen are actively traded during the Asian market session. Liquidity in Euro picks up during Euro markets open, and liquidity in dollar pickups when US opens. And I'll try to explain it here. So yeah, the market opens at 3 a.m. and that's the London market, and the New York market opens at 8. And the London market closed at 10. So the period, 11. So it closed at the period from 8 to 11 has the most liquidity in it. So you make the most money from 8 to 11. So you're on the street. And then at 4 p.m. the Sydney market opens, the Australian market. Tokyo opens at 6 p.m. because New York closes at 5 p.m. And at 4 candles that explain that you'll see it on the charts. Economic calendar, rising interest rates, increased investment flows, increased demand for currency, increase in value for currency. Less competitive exports means a decrease in trade but a stronger currency. Falling interest rates, decrease in investment flows, decrease demand for currency, decrease in value of currency, more competitive exports, increase in flows, what means weaker currency, decrease in money supply, increase in money supply, confident investors, nervous investors. Consumer price index is a measure of the over average change over the time frame of prices paid by consumers for a market basket of consumer goods and services. Indexes are available for the U.S. and various geographic areas. Average price data for select utility, automotive fuel, and food items are also available. The producer price index, the PPI program measures the average change over time in the selling prices received by domestic producers for the output. The prices included in the PPI are from the first commercial transaction Leverage. Leverage means that you're borrowing money in order to place a trade. Technical analysis. Beginning concepts. So the market begins with high highs and high lows. High highs and high lows. And high highs and high lows. Every currency, that's an uptrend by the way. The downtrends are the low lows. When the market makes low lows and low highs. So you can see here. Now, every currency pair has its own time frame where you can see the overall trend clearly. When trying to identify trend, higher time frames are recommended because lower time frames have more money, more movement, and therefore are more noisy. An indicator that you can use to identify a trend is moving average and moving average exponential. I usually set my EMA to 8 and my MA at 18. The EMA is blue and the MA is red. The indicator that you can use is moving average. Moving average exponential. Support and resistance. So support is when the price level at which a currency pair tends to stop moving down, then turns around and starts moving back up. As you can see here, price action is this point, and then the red is up. Same here. Resistance, price level at which a currency tends to stop moving up and turns around and starts moving down. Price hits this point. If the candle doesn't form over the new level of support resistance, it has not been broken and will result in a continuation of the current pattern. Look for areas of indecision. You'll see tester candles and candles that consolidate. There's 3 scenarios, such as we just saw. It's the most accurate. Gap is when there's a space between. Overlap is when it's overlapping on the candlestick has gone past. Zones where the market breaks out in either direction. Supply and demand. To find these zones, start with a breakout. Support and resistance is where we see price fall in an attempt to move beyond a certain price point. Support and resistance is where we see price fail to an attempt to move beyond a certain price point. Supply and demand is areas of strong price movement away from a zone of price action. A good example is a very strong rally. A little bit of sideways movement as buyers and sellers come to an equilibrium, and then a massive drop as if all the buyers were filled and only sellers were left. Market structure. Figure out trend. What's your market doing? In an uptrending market, when the market comes down, it's going to hit those support and resistance points, and if it breaks through, it's going to retest its high. If you see support and a Fibonacci PRC line up, then that's a confirmation. Price reversal zones. Yeah, 38.2%, 61.8%, 78.6%, and 88.9%. see here, you can have a measure. First counter term is a 38.2%. The second one is a 61.8% retracement. Now, market structure never buy in a seller's market and never sell in a buyer's market. This is the uptrend. You see the retracements. Price action makes a higher high and higher low. And then it breaks structures right here. Makes a lower high and a lower low. Break structures when the market breaks a higher low point. Whichever time frame you see as a break of structure, and only valid day. It's only valid on that time frame. If you're using the 1 hour time frame, the demonstration has to break structure on a 1 hour time frame. If you see it on a 30-minute time frame, it's invalid. So it's based on the 4 hour time frame. It will have a break of structure on the 4 hour time frame. The market doesn't have a current tap to create higher highs and higher lows, aka a standard uptrend. You can have lower, higher highs, but still not be an uptrend because the market is still creating higher lows points. As long as the higher low isn't broken, it's still an uptrend. This may be an area where the market catches its breath before continuing trend. And you can see there are uptrends. This is standard uptrend, and then there's a variation of an uptrend. And you can see high and high low high. And then it begins to make a lower high, but still keeps the same high low. And then price action creates a high high here, break of structure, creates a high low. And when it comes to the downtrend, it's the same thing. Price action makes a lower low, lower high, lower, keeps the same lower low, but continues to make lower highs. And then it breaks of structure, makes lower low. Same here. This is break of structure. And so we take a turn. The market was a higher low point. First selling opportunity after break of structure would be the first low high. Keep things at the same time frame. Yeah. The market broke the lower high point. The first buying opportunity after the break of structure would be the lower high. When measuring retracements, the market can retrace at 38.2%, 61.8%, 70.6%, 88.6%, or 100%, meaning the max. It can retrace to a higher low point. When it comes to Fibonacci retracement, here is the demonstration. The market retraced to 61.8% on a downtrend. 61.8% being one of the golden levels of Fibs. Price action creates 0.8 here. swimming against the current in the river. The key to successful trading is to quickly identify the path of least resistance or the up or down. The herd is made up of everyday people. You lead doctors, lawyers, engineers, money managers, etc. When the herd begins to move, emotion creeps into the decision-making process, which can cloud a person's ability to think objectively. Fear of being left behind, FOMO, and missing out on price gains is a strong emotion. Greed that brings traders into stock and strengthens uptrend. The fear of loss can force normal, rational people to sell positions, increasing the strength of downtrends. If you're not careful, it is very easy to see stocks moving sharply in one direction and be overcome by fear or greed. The key is to remain objective. Everything about candlesticks. As you can see here, this is the open of the candle, and this is the close of the candle, as it is a close of the candle. When it comes to bearish candles, it opens here at the top, and it closes right here at the bottom. Market timing is using analysis to know when to step aside as market conditions deteriorate, when to re-enter the market when market conditions improve. Understand the psychology of herd and to know when to move in and out. Rising price shows that demand for share contracts is stronger than the supply of shares contracts for sale. Falling prices show that supply for shares contracts ready for sale is higher than the demand generated by willing buyers. When the market mood of sentiment changes, the risk of loss increases for those who follow the previous trend. Long wicks, a candle with bearish implications. Candle closes right here, that's a creates a wick, and the candle at the bottom.
That thing is pretty long.
Yeah, lower upper candles.
What happened to your voice?
Nothing. I'm just reading off the thing. Yeah.
What's kind of changed?
Oh yeah.
You sound more tired.
No, I'm not tired.
And your voice is saying that I'm tired to me.
No, I'll get tired, dude.
Okay. This sounds like it.
I understand. Long upper wicks are seen as bearish since price slowed well over the price high. Long lowered wicks are viewed as bullish because the price closed well off of the price low. Short candles with long wicks are viewed as early warning signs that a reversal in trend may be imminent. These types of candles are the doji and the spinning top. Long white candles, bullish candle on an uptrend confirms trend. On a downtrend, it indicates early signs of a reversal in the overall trend. Long black candles, bearish candles on a downtrend confirms the downtrend, while on an uptrend it may be an early sign of a reversal in overall trend. As you can see, here's the candle. It opens, closes here, and Short candles show indecision among buyers and sellers as price ends very close to where it began. Think of a short candles down higher, low, higher volume as trending hitting a brick wall. Some as trend hitting brick wall. Sometimes price will continue and break through that wall, but in many occasions a price reversal of the same sort follows the short candle. Candle with no upper wick is called a shaven head. Candle with no lower lip is called a shaven bottom. Bullish white Maribozu candles indicate buyers were in control throughout the entire session. Bearish black Maribozu indicates buyers were in control throughout the entire session. Open Maribozu is this candle right here. It's a candle with no wick at the open price. And closing Maribozu is when a candle with no wick at the end, at the closing end of the candle. Spinning top, a candle that has a small or short wheel candle with wicks at each end. Spinning top wicks are always at least twice as long as the body on each side. This shows that buyers and sellers each had the upper hand during the session, but and price close to where it opened. This is meaning in a trending market as it's an indication that a change in price action is imminent. This mere presence of a short candle body in a trending market is enough evidence that a change is taking place, especially on earlier than normal volume. Doji candles. Doji candles is very important. Candles stick as it shows that neither buyers or sellers are able to gain the upper hand and close and the closing and open prices are virtually equal. A doji in a trending market has more significance than a doji in a range bound choppy markets. It also gains importance if these are doji before. Dojis are more reliable on uptrends as the trader's psychology is usually bullish, and same clean on uptrends. The appearance of a doji in an uptrend signals that uptrend may be declining and pressure increasing. On downtrends, this means price action can continue to fall under its own weight. Identified by long upper and lower wicks, signify an intense battle between buyers and sellers. This is an especially strong signal in a trending market, as it shows that counter-trend forces are able to hold events or decline depending on the direction of the trend. Gravestone doji has embarrassing implications on uptrend as it shows that the opening and the closing prices were at the bottom of the daily range. On the downtrend, a gravestone can positions. Careful when thinking of taking a trade on this doji in a downtrend. Dragonfly doji has bullish implications when it appears in a downtrend. The opposite of the gravestone doji in the price opens at its high for the day before. Sellers push the price sharply lower. On an uptrend, it has bearish implications, so it shows that sellers have become more active as implicated by the lower weight evidence of a weakened uptrend. Star, a candlestick formation that has a strong reversal implications in a trending market. The psychology behind this pattern shows that the currency trend is in danger of reversing. Formed when a small-bodied candle gaps away from the real body of the previous candle, it's preferred for the real body of the star to form outside the shadow of a previous day. They commonly occur as the spinning top or doji. Morning star occurs in a downtrend, signals reversal in a downtrend. Pattern consists of three candles. The first candle is a large bearish candle that reinforces the downtrend in price. A shooting star occurs in an uptrend, signals a reversal in uptrend. Pattern consists of three candles. The first candle is a long bullish candle that reverses the uptrend in price. Hanging man candlestick, hammer candlestick, umbrella lines, signal candles that also have strong reversal implications. These lines resemble the dragonfly doji, the only difference being the body, also called the hammer or hanging man. These lines gain their significance from where they appear in a trending market. Hammer forms in a downtrending market and is an inclination bias are stepping up, which means a bottom may be near. In order for these things to happen, price has to be in an uptrend or moving, or in a downtrend or move, or trade opens and sellers apply pressure, placing price considerably lower. Buyers appear, then push price back up to near where it opened. This means that a day that clearly favored the sellers ended in a stalemate that encouraged new buyers. Hangman forms in an uptrending market and is an indication that sellers are increasing activity. 4 keys to the psychology between this pattern. Price has to be in an uptrend and moving high. Trade opens and sellers apply pressure, placing the prices lower. Buyers appear and price push price back up to near where it happened. A day that opened with so much promise on the gap. Hello? Okay. A price has to be in an uptrend and moving higher. Trade opens and sellers apply pressure, pushing prices lower. Buyers appear and push price up to near where it happened. A day that opened with so much promise on the gap higher opened ended in disappointment as there was little upside progress made after the open. While there are great indicators of counter trend forces increasing, it's always wise to wait for some form of confirmation that a reversal is taking place. Engulfing pattern, a strong two-candle reversal pattern that forms when a candle completely engulfs the real candle body of the preceding candle of the opposite color. These candles, regard of this direction, show a sharp change in psychology with the market. Bullish candle, bullish engulfing candle. Two patterns here, and then this is how it'll come out on a higher time frame. And then this is a bearish engulfing candle, and this is how you'll see it on a higher time frame, lower time frame, higher time frame. Here's another example of a bullish engulfing pattern. It's called a piercing line. A piercing line, a two-candle reversal pattern that occurs in downtrends. Just like the bullish engulfing pattern, the first day is a candle that moves in the direction of the downtrend. However, the first day begins in favor of the bears, as that day's opening price gaps below the low point of the previous day's candle. Notice that the gap is below the low point on the entire previous day's candle, including the lower shadow, not just the real body. The pattern is completely on the second day when the white candle closes at least halfway in the real day of the previous day's candle. So here you see a low time frame, like a 1 hour time frame. This is the candle that I make. And then on the 4 hour time frame, for example, you'll see that it'll be a candle. It's a bearish candle, but it has a so on here, this is a dark cloud candle formation. For this one, you see that on a lower time frame, it's going to be a bullish candle with over a wick, and then this one is going to be a higher time frame candle. Dark cloud cover is the bearish counterpart of the piercing line. This pattern forms in an uptrend and turns what begins as a bullish event into a strong bearish reversal signal. This first day consists of a long white candle that moves in the direction of the trend, followed by a candle that gaps completely above the high of the white candle. before reversing lower to close all these halfway into the real body of the candle, first day's candle. This creates a bullish hammer or higher time frames. The psychology of this pattern is bearish, as the first day confirms the uptrend, which is comforting to the bulls. The first day opens with the same euphoria as price gaps above the high upper wick of the price of the white candle before reversing lower. This creates doubt among the bulls as the sustainability of the uptrend. This causes nervous bulls to exit, which builds downside momentum. Harmonic patterns. So the first harmonic pattern would be the crab. It's a bullish crab, as you can see here. Here it starts at X, creates a pattern like this, and it's to A, B, C, and D, and it's a bullish pattern. And then you see you have here the bearish crab. It goes X, A, B, C, D, and ultimately ends up being a bullish pattern, a bearish pattern. So this is the back. It's the harmonic pattern. This is the bearish back. Starts at X, goes to A, goes to B, goes to D, C, and then goes to D, and then it goes bearish, and then this is the bullish back. Goes from X to A, goes to B, C, and then D, and then it goes bullish. And then this is the 3-point drive. Essentially, it's the bearish break 3.5. This happens where the break of structure happens. And then you measure the retracements. And then this is the bullish 3-point drive, where it's price action was previously bearish, break of structure, and it goes bullish. This is the butterfly. It's the bearish butterfly. This is the bullish, the bearish butterfly. It's when it goes from X to A to B to C to D, and then you have the break of structure and price action goes bearish right here. And then you also have the bullish butterfly. It goes from X to A to B to C to D, and then break of structure happens here. Price action starts. Then you have the bullish Gartley. The bullish Gartley is the X, A, B, C, D, and it goes bullish. The break of structure, and then it's the bearish Gartley. X, A, B, C, D, and then it goes like that, break of structure. And then this is the ABCD pattern. This is a bullish one. It's pretty standard. And then it's the bearish one. It's there you go, break of structure. And then this is the trading strategy. Trading strategy is the basics of technical analysis. Concept used: the support and resistance, supply and demand, Fibonacci, price action, and trend lines. Support and resistance provide a strong foundation of entries. Don't even consider any trade without the confirmation of support and resistance. Daily time frame support and resistance is used a lot and can be marked off using the line chart. Red. The 4-hour time frame support resistance is used a vast amount and can be marked using the line chart. As you can see here, you can create the 4 hour. You see the support and resistance, and then here's the 1 hour time frame. As you can see here, every now and then is used when analyzing and is marked off based on wicks. Trend lines are based off of support and resistance, which play a role in confirmation. Everything under the trend line is considered a sell zone. Everything above the trend line is considered a buy zone. With support resistance, the market can either test an area or break an area. There you see price actions creating higher highs and higher lows. We have a breaker structure here where the trend line has also gone around 1.11 trading Swiss franc, and price action has created a breakup structure here. You have the buy zone where you have a buy here on the support resistance line. You have a buy here, and then you create higher highs and higher lows. And then on the sell zone, you would be able to buy here because that's when the breaker structure happens. Previous correction creates a lower low and creates a lower higher here. A Fibonacci is used to track retracements and projections as well. So you see, you start the Fibonacci here, and you try to get to at least right here, the higher high. Price action creates a higher low here at 23.6, but ultimately falls to 50% retracement. Once it falls to 6% retracement, creates a higher low, and then creates a higher high here. Breakup structure happens again through the trend line, and you see it's on a higher time frame. So that right here is the 4-hour time frame. And you go ahead to the 1-hour time frame, you can see it more in depth. Using the Fibonacci, you can create a retracement. So you can use it to use the Fibonacci for uptrends and downtrend. Here's how you measure the downtrend. You put it, start at here. You measure the first retracement as price action created a lower low and a lower high, and then it goes here and it doesn't. It goes here, creates a lower high, and then continues to create a lower low here. Creating another lower high. And then this is the trading strategy for the 4-hour time frame. And noticing an engulfing candle pattern or the information of when we go on a lower time frame for possible trade entries. Example, engulfing pattern on the 4-hour time frame, switch to the 1st-hour time frame, then to the 3-minute time frame, and then to the 15-minute time frame for a possible entry. When noticing an engulfing candle pattern or the information or the formation of one, go on a lower time frame for possible trade entries. Example: engulfing pattern on a 4-hour time frame. Switch to 1 hour time frame, then to the 30-minute time frame, and then to the 15-minute time frame for possible entry in 1 hour time frame. And now we're on the 30-minute time frame. And then this is the 15-minute time frame. Once a candle reversal pattern forms an engulfing pattern, a candle happens after it retraces in some way to fake people out, then that's how you enter. Trading strategy. Time frame analysis. When there's too much noise on a lower time frame, we'll go to a higher time frame. This is the 15-minute time frame. And then this is how that same area will look on the 4-hour time frame. Trading strategy. Next, use the monthly time frame to find your major levels of support and resistance. These key levels on the monthly time frame should be less than 10,000 pips. If it's a 5-figure number, it's invalid. The first thing you want to look at when you look at the chart is structure. This helps with anticipation. Trading strategy, for example, this is the Swiss franc paired with the USD. On an uptrend, the USD is getting stronger because the Swiss is getting stronger because it's the first pair currency. It's an uptrend. The base currency is going to always talk value as the market is going up. As the market is going down, that's increasing the value of the USD, which is the second pair, which decreases the value of the Swiss franc. This is engulfing candle entries. In an uptrend, only valid candlesticks patterns to look are bullish engulfing. So the markets make a morning star. These two candlesticks together, you can cancel the doji and just put those are good entries and can be found on higher lows. On a downtrend, only valid candlestick patterns to look for are bearish engulfings. They are located on higher low points. These candlesticks together, you can cancel the doji and just put those are good entries and can be found on higher lows. higher time frames, the market is flowing in one direction. There's no reason to look for trades in the opposite direction. Don't chase the market, don't flow with it, don't react, respond. The process of maintaining a trade, getting into a move itself takes a lot of patience and a lot of playing the waiting game. Now, as tedious as it may seem at times for an impatient trader, trust your analysis. While in a trade, it's important that you're still analyzing. Make sure to look at the pips and at the money. Trading is about using your own judgment. Using time frame correlation is important in your trading as well. It's important to be as objective as possible. The market is never against you, it's showing you data. Always keep track of trend. Every candle tells some kind of story. Remember, it's you versus you. You'll always win. Getting into a move itself takes a lot of patience and a lot of playing the waiting game. Not as tedious as it may seem to an researcher and analysis. While it's in a trade, it's important you're still analyzing. Make sure to look at the pips and not the money. Risk management. When it comes to risk management, trading equals vision plus objective. The objectives are to follow your risk management plan, gain and maintain and grow account, make assistance, withdrawals. Biggest way to be profitable, consistent, and to control your ego is to make consistent withdrawals after winning. Look for a 1 to 3 risk to rewards, or 1 to 5 risk to rewards after the no risk, no reward, no hedging. One trade, multiple entries are 4 and a better, but to put 10 small trades than one large lot size, because it allows for less slippage and drawdown. Trading process, trade plan, risk-based thinking. The approach you apply in order to effectively manage the effects of risk, positive or negative, on your strategic operation objectives. Identify risk. Start early and work iteratively to identify access and communicate risk of trade. Risk assessment reduce the probability and the threat, increasing the probability and impact the opportunity. Execute trade. Now, when you're executing a trade, make sure that you're risk action aware of trading your approach. Right, your goals should be to increase confidence in obtaining the intended results, further increase trading performance, and increase satisfaction of self. Great trade. A great trade. A great trade would be the 1 to 3 restore reward or a 1 to 5 restore reward trade. The analysis of the trade shows full confidence in the measures in in place. Then no further action will be deemed necessary than to monitor the trade. A decent trade will be a 1 to 3 restore reward. The analysis of the trade shows a lack of full confidence in the measures already in place. The implementation of the tailored risk tailored risk-based trading approach will be required. Risk monitor or reporting, identification, implementation, and management of appropriate action to mitigate risk. Key to access structure is key for assessing when to TP or hold. Identify, access, and communicate risk toward trade. Example, price approaching supply demand around 35,500 35,555. Another would be seller's exhaustion after 10,000 10 points. Seller's exhaustion after some point. Checkpoint. Take profit or close for minor loss when making short-term risks. Understand long-term impact beforehand. Better to cut trade early and real analyze than to suffer counterproductive outcomes. A perfect swing trading scaling strategy would be this here. The best swing trades come from a 4-hour and daily time frame engulfing candles. Engulfing either leads to 1 hour engulfing either leads to 4-hour engulfings or counter trend based on higher time frame overall market structure. So as you can see here is the first entry right about at 1.2. As price action continues to go bullish, stop loss is at 1.2. And then as price action go bullish, creates higher highs or higher lows. And what it says here, it says first stop loss placed to break down, and then it goes there, and then the second stop loss place keep the same risk. Fundamental tips. Before technicals, look at Florence Factory for the economic calendar. Understand events coming for the week. Yellow folders aren't really impactful. Orange folders can still move markets. Red folders create larger movements within the markets. Avoid trading on weeks where there's a lot of news. Explaining supply and demand to a high schooler. let's say Jordan releases a new shoe. It's a highly sought after and rare shoe. Now let's say 1 million people want to buy this specific shoe. This is called the demand. There's a high demand for this shoe because a lot of people want it. Now let's say let's say Jordan only releases 200 pairs of this shoe. Being that the shoe is very rare, this means the supply of the Jordan shoe is very low. A product, but a low supply. A product, but a low supply. The price for this product tends to be extremely high because 1 million people are in demand for the shoe, but there's only a supply of 200 pairs. The price of the shoe tends to be very high. This concept only works when it comes to highly sought after items. Similarly, the demand for the USD has been high due to it being a safe haven and also because of its high interest rates, which I will explain. Safe haven currencies thrive when investor fear is running amok. This is because of perceived protection that they offer during times of financial turmoil. The war of Ukraine and Russia being one of these times. This is in addition to the USD raising their interest rates, meaning the USD is more appetizing to foreign investors, leading to an increased demand for the USD, but with the supply of USD running out due to everyone using it, making its prices higher, also causing inflation as the supply of the USD is being stretched. Higher interest rates also mean increased investment flows and the value of currency, as investors are always looking for the highest return on their investment for the least amount of risk. In the previous scenario, USD equals Jordan. Increasingly, the supply of euro is at the highest it's been in a while, as its usage rates are at the lowest it's been in a decade. This, as well as its low interest rates, means low investor interest and a decreased value of the euro has investors becoming less confident in investing in euro. Referring to the previous shoe example, Shaq is buying the shoe. Shaq is supplying the market with 1 million shoes, but the shoes release only 200 people buy it. This significantly lowers the value of the shoe as the demand did not meet the supply of the shoe. The economic calendar. Price rises as demand increases. In a safe haven currency, price falls as like say for example in a safe haven currency or in Ukraine and Russia meant that the USD rises as the demand rose. Price falls as supply increases. Price falls as demand decreases. Price rises as supply decreases. And it comes to interest rates, price rises as demand increases. Offers higher interest rates. Demand for the country's bond will increase. Investors buy bonds in that country's currency increase, and demand for local bonds will increase demand for the local currency. Increase in demand for local currency will push the value of the currency higher. Rising interest rates equals a stronger currency. Falling interest rates equals a weaker currency. As the USD moves, interest rates move like a shadow. Interest rates don't move until after the market economy moves. USD. It's the central bank's way of steering the boat. Hard times create strong men. Strong times create easy times. Strong men create easy times. Easy times create weak men. Weak men create hard times. Hard times create strong men. And this is the terminology of a retracement. A retracement is a technical form used to identify a minor pullback of change in the direction of a financial instrument such as a stock or index.